So I'm James Knoedler, and I'm a portfolio manager with Evenlode Investment. Evenlode Investment is a UK-based boutique fund manager managing long-only equity portfolios. I discovered the pursuits of appreciating classical music and listening to opera in particular, but also reading novels and poetry through my parents. My mother is a classical pianist, and I grew up listening to Chopin, Brahms, Dvorak, that sort of thing, the romantic repertoire with her, which I've always very much enjoyed. And my father was briefly a professor of English in America. He's always studied and taught English, and through him acquired a strong interest in medieval literature. Actually, that's where his specialty was, but also in the rest of the canon. So a great benefit from my parents. I wish I could play the piano. Well, any musical instrument really, but the piano has got this wonderful repertoire around it of solo work. So that I squandered all of the free lessons I got from my mother, and I don't think I'm particularly musical either, unfortunately, but one I wish I had. My favorite creative as an artist, anything of that sort, was an author, probably John Milton. All of the great poets are fantastic to read, Edmund Spenser. But Milton, he had a way about him, a style, extreme stylishness, which is very compelling. Working today, not sure, pretty much, you can take any of the big opera singers, Johann Kaufmann or Bryn Terfel or someone like that. I'd never say his name right, Rostovsky. They're all just magnetic to watch. So how would I define myself as an investor and my personal investment philosophy? I look for investments which are long duration and have, well, actually infinite duration, ideally, and which can generate attractive returns ahead of inflation for a very, very long period, where you don't have to worry about reinvestment risk, roll risk, anything like that, which can grow as an index on the broader world economy and ideally go a bit ahead of that. So that confines me, well, pushes me towards listed equities, which I think have got the longest durability out there among financial instruments. And then within equities, listed equities, it makes me concentrate on ones which have some sort of hard to replicate competitive advantage. It can be household names like a Colgate or a Diageo, or it would be companies with more esoteric reasons for existence like an Experian or a Verisk or an Informa. But those sorts of companies have found through my career compelling as investments with a degree of valuation sensitivity built in as well. The single investment principle on which I would never compromise is the quality of the instrument. So it has to be an equity with durable pricing power, and that pricing power comes from that competitive advantage we talked about. When you don't have that, you have so much less security and visibility over the money you're risking, and it's not and something in my experience it's never worked out for me. And one of the great rules is don't make the same mistake twice if you can help it. So I'm very, very firm on that one. An ideal investment for me and for my firm would be a company which provides a product which makes a big difference to its clients, such that they're willing to pay up for it, and which has a really long roadmap ahead of it of gradual, predictable improvements at the margin. So, for example, I was just with the CFO of a large professional services company, and they sell a number of products to people who are in the worlds of law, accounting, tax, not glamorous ones, but important ones. So that's also important. It has to be a product which is integral to daily lives and to the daily functioning of the economy. And their product improves their outcomes for their clients such that their clients will pay up for it. The clients depend on it for their daily activities. And there's a lot of what we call unmet need. So while the products are great, they can improve a lot. And the client needs are always becoming more complex, more demanding, as regulation increases, as the complexity of the digital world increases. And that's a thread that we would like to find through all the companies we look at. Those principles of openness to innovation, client reliance on it for the workflow, for the activity. And I think to really importantly that you're pricing commensurate with the improvement you're making to your clients, but you're not being egregious, you're not being greedy. and that you're reinvesting in a lot of that pricing into your product to make it better. How do we find investments? So starting at a very high level, you look at all the listed companies in the world, and the MSCI ACWI or the MSCI World indices, they comprise about 6,000, give or take, but most of them are not that suitable for us. It's very easy with modern data and computing to screen for the characteristics you want, which your highest level of gating is, does a company make a return on capital well above its cost of capital? And has it done it for a long time? So that screening is very simple to do, very mechanical, but it's essential for screening out the stuff we don't want. So that screening leaves us with only a few hundred companies in the world which meet our criteria. We find that most of the stuff is on our map already. What really is going on is that within that group, it's a question of prioritizing. And the really important things for prioritizing, it's more about your qualitative understanding of the business and your network of contacts. So what are people talking about in the market? So competitors, suppliers, customers, employees, what are they saying about this company? What are their peers saying to them about them in conferences, in your meetings with them? What's coming up in the market share data, in qualitative comments being made by experts, that sort of thing. So you put that together and that gives you a more informed shopping list. There was a company that we were looking at that we had been invested in that was involved in it was a commoditizing area. So while there was strong growth in it, it was telecoms, the market was becoming less and less differentiated. It was much more about how many minutes am I getting for my plan or what have you, and there's a race to the bottom logic. I mean, like, okay, fine, great, but not for us. And what we ignored in our haste to exit was that this business had within it a really fascinating network developing, which would enable people to move money around within the system. And this network had very clear benefits. The more people were in it, the better it became. And it became ubiquitous pretty quickly. The thing that I didn't pick up on was when you have a situation like this, when you have a mix shift within a company, you can move from one type of financial paradigm, what Charlie Munger calls a mental model, to another. So you're moving from one where you're selling a commodity and you compete largely on price, not features, to one where you're selling access to a network. And that network is hugely beneficial to its members. So the financial characteristics of doing that are very different. So that was one thing that's always stuck with me, is being very, very attentive to changes in the composition of a company's business. It can work against you and it can work for you. So final thoughts on investment philosophy. I think it's hard to say, because it's the reality is that investing is, you're on a journey as a professional investor which never ends. There's always surprises and things you learn. Humility is hugely important because it means that you're open to learning stuff. You have to balance the humility with a core of determination, that you have a set of principles you stick to. So you can't be blown around too much by the markets. So again, it's striking a balance. It's a very demanding, a lot of it is about emotional maturity, which again is a very demanding thing. No one finds it easy to learn. Within the sphere of what we do, what I do, which is long-term investing in compounding equities, a lot of it is resilience when you're going through a market cycle. The reality is that no strategy works all the time. If one did, I think the markets would have puzzled it out by now. And it's having the faith in your own, but also the empirical confidence in your own discipline to stick with it, and having a really clear set of criteria for what matters, what you really care about. Price is a really important signal in the markets, but it's not the only one. And where you make your bread as an active fund manager is understanding when you should really lean on your toolkit of just whatever else you look for, quantitative information, qualitative information, and prioritize that ahead of the price. And that's really hard. So all of this comes down to balance, to maturity. I just want to wrap up by saying thank you to everybody who's a client of Curate, who works with Curate, who works for Curate, for really appreciate the faith, the respect and the commitment you guys put in, and we do our level best to meet your expectations.